Welcome to the Tech Exits Podcast. In today's Buyer's Corner, we'll explore the M&A landscape from the perspective of top acquirers, gaining insights into their acquisition strategies, challenges, and lessons learned. In this episode, we're speaking with Ibrahim Abdel Rahim from Moonbase Capital, an investment firm founded in 2016. Moonbase focuses on partnering with high-growth technology companies, providing both capital and strategic expertise to accelerate scale. Ibrahim joins us to discuss Moonbase Capital's approach to acquisitions, including how they select companies, manage integration challenges, and maintain transparency throughout the process. We'll also dive into his advice for founders preparing their companies for acquisition, emphasizing the value of preparedness, cultural alignment, and building trust. So, let's begin. Thank you, Ibrahim, for joining us.
Thank you for having me. Very exciting.
Well, Ibrahim, to start off, can you tell us a bit about Moonbase Capital?
Yes. So Moonbase backs entrepreneurs who go out and buy companies. So it's basically entrepreneurship through acquisition. We are what you call a search fund investor. Search funds are vehicles that are created by these entrepreneurs, young entrepreneurs who, instead of going out and by and starting a startup, are entrepreneurs who want to acquire a business, basically. And we back them up until they find the business, and then we're either on the board or not, and eventually they own the business for 5 years and they exit it.
That's a really interesting approach to M&A. On the same note, what is Moonbase's acquisition mandate? Is there a specific vertical or sector you're more interested in backing up?
We are quite diverse, actually. We have companies in so many different sectors. Technology is just one of many sectors for us. In the search fund world, technology is actually the biggest sector that entrepreneurs like to invest in. But when I say technology, it's more software, maybe B2B SaaS, consumer electronics, hardware. So it's not really your VC type end of the line technology. It's really software and a bit old school technology, if I may call it that. And the way it goes is we have a very specific mandate, which is a size, usually between $1 and $5 million of EBITDA. We have need companies that are growing, that have good margins, that are quite safe, and that don't rely on the old owner too much, because one of the things we do is we take the company on. Our CEO runs it from day one, so it cannot be too much reliant on the old CEO. So that's more or less our mandate.
Have you seen change over the years in the tech landscape? Are there some trends you see in the future?
I mean, yeah, it's becoming much harder to do deals in the tech landscape just because of the speed of movement. I mean, AI and the introduction of so many new technologies is making it very hard for us to evaluate whether a company we're buying is actually going to be disrupted or not in the next few years. In the past, this was much slower, so it was easier for us. The problem we have is that because we are not experts in one vertical within technology, and we're more generalists, so it's harder for us to know the insides of any sector or the specificities that you may have. So for us, it's becoming more and more challenging to pinpoint which sector to invest in, which company to invest in, while we don't know everything around that industry,
That sounds really interesting. And as you said, AI is definitely growing. At this point, who isn't investing in AI, right?
Yeah.
Now, from an acquirer's perspective, what do you think is the most difficult part of the acquisition process?
For us, the product is usually where we worry the most, because especially in tech, if the product is not strong, if you have a big debt in terms of product, then it becomes very hard for us to recoup that during the years of running the business. So for us, the product is usually the thing we worry about the most. The other piece, which for us is a big worry, is to really understand the value proposition and how the future will look like. Because in many cases, as we said, technology is moving so fast that the value proposition that works today is not necessarily something that will work in the next 3 to 5 years. So to get this piece, which is That's the value proposition the company has today. And this is how to look like in the future, given other competition and other value propositions that are being created, is for us quite challenging. You need to really get experts in this specific niche and try to make sure you figure out all the details. But yeah, that I would say these two things are the most challenging parts.
Definitely. That must be something that takes a lot of time for you to analyze and see how the transaction is going to finish, right?
Yeah, for sure, for sure.
Is there an average time you see transactions happening?
So for us, it's actually very different than other acquirers because our biggest pipeline comes from these proprietary deals, and we have our searchers or our entrepreneurs. They go and they contact companies that don't even want to sell or don't even have selling on their mandate yet, and they convince them to sell their companies. And in this case, it could take up to a year, just because it can take us 6 months to convince the owner or the founder to sell their business. But in general, I would say around 6 months is the time it takes from convincing an owner to sell their business all the way to closing the deal. I'd say on average it takes us 6 months to do that.
Interesting timing. Your approach is different from most other acquirers. The competition must be hard. How do you handle that competition? How do you think Moonbase stands out?
The good thing about search funds is that usually we are the ones who knock the door of the businesses without brokers. So we're the ones who go and initiate the idea of a founder selling their business. And in many cases, we're actually the first ones there. Naturally, the founder would find a broker or an M&A specialist and start looking for other competitors to us. But in general, we have quite this edge. Now, we have something also that is very different. We buy the company from day one, 100% run by the entrepreneur, which is a very big difference than if a private equity or a financial investor buying it, because in this case they want to keep the founder on for a few years. Now, we don't do that. We are happy to take over the business from day one. Of course, there is a transition period, but we're happy to take it from day one. And this makes us generally quite attractive to sellers, because in many cases they want to move on to doing something else. And especially sellers that have been doing it for a while don't want to be run for another 5 years by a financial investor who would, put them KPIs and ask them to do certain things. So in our case, in many cases, we're quite different. So competition for us is really the first few months until we have a clear exclusivity. Once you have exclusivity, then it's up to us to close the deal. But usually we get this exclusivity just by us being such a different acquirer than the average acquirer.
You've commented about how you have a lot of communications with the founders. What are some of the common mistakes you see founders make when they prepare their companies for acquisition?
Well, I'd say there's a few. One of them is really the timing of when to sell. I think sometimes the timing is more based on them feeling they want to change what they do or want to move to another role. Timing is key, because if the company has been growing for a few years, if margins have been steady for a few years, it's much easier to sell than if you had the bumpy years before. So I'd say really choosing when to sell is something that makes a big difference. The other is really making sure that you don't have a concentration with one client, or you don't have a big churn. I'm talking more about really software, SaaS, B2B SaaS, etc. And for these companies, it's very important to make sure that you have a healthy client and customer base that is growing and churn is low, etc., etc. And this can be manipulated. I mean it in a good way, which basically means you can manage it to make sure that when you exit, people look at your client base and see that you are actually having a growth story with clients that like you and are not churning away, and etc., etc. Naturally, product also is important, but I'd say these first 2 points stand out as things that sellers can do better.
That's a great insight, Ibrahim. Timing truly is key. Going off of that a bit, there's a lot of deal breakers that can surface during an acquisition process. What have been some of yours? Has there ever been a time where you had doubts during the process?
I really think trust is the most important. If you feel that the seller is not trustworthy, they're hiding something, there's something that they said which in the due diligence turns out to not be the case, this is what worries me the most. Because at the end of the day, a seller can always hide so much. They have such a arbitrage in knowledge in their company versus what we are trying to figure out. So at the end of the day, trust for me is number one, two, and three. I would say any change in the deal, like for example, if they midway through change the price or change anything that they had said they wouldn't change, this all for me would worry me a lot in terms of trust. And also I would say the current trading, like usually it takes, as we said, maybe 6 months to close the deal. So to really try to understand how the company's been doing during these months and the month, 6 months before we started is very important because in many cases, the founders, the other eye goes off the ball and you see numbers going down. And for me, this is also a big worry, that things are not happening the way they should be. So, yeah, I'd say trust for sure is the most important and any sudden changes, but also how the company is doing lately, the last year.
Of course, totally makes sense. And as you said, trust is a strong base for running a process. Also, on a similar note, you have to have trust with the sellers. You also need a strong team that you can trust to support the M&A process. Who do you think are the critical team members sellers require to ensure a smooth process?
I think the CFO is key. I think so many of the processes linked to the financial part. So in many cases, you have companies that do not have a very sturdy finance manager or a CFO. And I think this is one team member that's very important. Of course, there is a number of other team members that are important when you're buying a company, but for the process itself of the M&A, I think CFO is by far the most important. The other member, which is not part of the team, but I think is very important, are the lawyers, because in many cases you have lawyers that either ruin the deal or make it happen. And to have a lawyer who has experience with such deals and who knows how to talk with the other lawyer and how to close a deal, I think is also extremely important. So I'd say, other than the CFO, I would really focus on the lawyer. And to have an M&A firm is always it could be good and bad, but I think it's good that you have at least people talking the same language. Because in many cases, the founder who's selling the business never sold the business before. So for them, it's so new. And there is many things that they could be scared of, but an M&A boutique or a lawyer can easily make them comfortable by explaining how usually it works.
Our sponsor, the Quorum Group, recently just released a video about how to choose an M&A attorney. You have to do it with great carefulness because of how vital it is to have the right backup during a process. What are some of the challenges you face post-acquisition?
I mean, the way we usually do it within search funds is we spend a year, maybe a year and a half, learning about the business, learning about the industry before we do any big changes. So for us, the biggest step number one is basically how to understand the business, the people, the market as much as we can without doing too many changes. Now, that said, if there is one or two topics which we need to understand the most and usually worry about the most, I'd say product is very important because product is usually the thing where we are least experienced. I'm talking about tech acquisitions, and usually product is quite complex. So for us, product is very important to try to figure out if there is any debt that we need to fix, if there's anything in the product. And then very important always are the customers, because in many cases you need to make sure that you're not inward focused. You need to make sure that you're serving a certain value proposition, a certain customer. And as a new acquirer, it's always tricky to really understand what makes the customers click and why do they really need our services. So it's very important to spend some time in working with the customers, working with product, trying to get this piece right.
Okay, in your opinion, Ibrahim, what advice would you give founders looking to make their companies more attractive for acquisition?
I think it's very important to again to choose the right timing. I would sell after a few years of growth and high margins, and this is I know easier said than done. However, if you're able to grow for a few years, push hard and grow well, and especially if the margins, EBITDA margins are high, and then you're in a very good space because the future looks very bright to whoever is buying the company. Um, Again, there are ways to do that. I mean, there are years when you want to invest in team members and product, but then if you're selling, maybe it's better to make sure that you have the right growth, the right margins, and yeah. The other important one is really the concentration of customers. If you have one or two or three customers that make up a lot of your revenue, you need to make sure that you get more customers because concentration is always something that worries people who are buying the company. High churn is also something you have to deal with. Especially if you're like a software company, you need to make sure that you don't have high churn. So there are these things around customer and margins and growth that I would really make sure that you have them right before you have the company up to sale.
Thanks so much, Ibrahim. Before we close, what piece of advice would you give to others considering or currently going through tech M&A?
To really say expertise in the technology and in this specific industry, because as I said, it's moving so fast these days. So many new startups are popping up, doing things differently than they used to do before, and the expertise in how this market is moving, what exactly new technologies are coming up, I think is so important to make sure that you don't buy a company and then figure out that it's going to be obsolete in a few years. So I'd really say this: get experts, talk to people in the market, try to understand customers, what are they looking for, and especially what new products are coming up, how can you be disrupted, basically. I think this is the biggest worry, is that you buy a company and then figure out later that you bought it and there is another product coming up in the market that's better than yours, or there's a VC-backed startup that is doing things cheaper or faster. Or so I'd really focus a lot on the expertise of making sure that this is sustainable. It will take a few years, and if not, then at least you have the team inside that can make sure that you stay on top of the technology and on top of this market. So I'd say experts.
Thank you so much, Ibrahim, for your time. We appreciate it. I think our audience will find great value in your insights and advice.
Thank you so much for having me. I mean, it's I think that in the next years you'll have a lot of searchers, which are entrepreneurs, doing this type of deals. So I think it's nice that your listeners can think about that as some route of exit, which is the search fund world, entrepreneurship through acquisition. This piece, I think, would be a major piece in the future. So it's good that people get to know it early on.
Thanks a lot, Ibrahim.
Thank you, Larry. Thank you for having me.
Thank you for joining us today. Are you considering selling your tech company? Head over to quorumgroup.com, our tech exit sponsor. If you'd like to learn more about selling your tech company, join us at one of our Tech M&A Masterclass events. Attendees of the Tech M&A Masterclass will gain practical knowledge on how to achieve the maximum valuation for their company gained through expert-guided workshops, hands-on exercises, and M&A case studies, or online through our Tech Market Spotlight webcasts or our premier virtual conference, Growth and Exit Strategies. Our next GXS Scaling and Selling in the AI Era will take place online on November 6th. This is a unique opportunity to learn key insights on the latest tech M&A trends, valuation strategies, and how to succeed in today's market. You can register at wfs.com/conferences and hear directly from speakers representing venture capital, private equity, strategic buyers, M&A experts, and tech CEOs who have built and sold their companies. Head over to wfs.com for more details. We'll see you again for the next episode.